hear this a lot. People say, why in the heck would I loan money to myself when I can just go get a loan from the bank? Why are people putting money in these cash value life insurance policies and then they're going in and borrowing money from themselves? Why would I do that? That sounds ridiculous. Well, I'm going to show you through blocks, little Jenga blocks, how all this works and why people are actually doing this, and why, honestly, if it makes sense for you to do it too, wouldn't be a bad idea. Let's play a little Jenga. So if you're familiar with a little word called arbitrage, it's basically essentially meaning that you are going to outbeat or outpace interest on the good side versus the bad side. Meaning you can take something in its most basic form, and maybe if you look at it just like it is, saying, oh, this is costing me money or I have to pay interest on this. If you can take that and make more interest on what you are paying, then there's actually a net positive in that. But I feel like actually trying to say it in words versus what I'm about to show you here is not going to give you the full picture of what I'm trying to say. Now, if you know how these policies work, then you know that essentially it's just an insurance policy, right? You're paying for that so that you can have access to a cash value account. You can choose to have that cash value account grow fixed, which is kind of boring and slow, variable, which is like a roller coaster, and index, which is kind of like a staircase, or kind of like this ladder that you see here. And so essentially if you choose indexing, that means that you're only going to get the gains of the market. You're tied to a certain strategy, but when it goes down, you're just going to stay where you're at. So this is continuous growth, never any loss. And so that is just the basics of how those cash value policies work. Now, I'm going to show you an example of index universal life because I'm going to show you how basically cash value grows in an index policy. And when you go to use loans, what that looks like. There's two types of loans with these policies. Typically, you'll see what they call a wash loan, which I like to correlate kind of like to a withdrawal, because essentially we know what a withdrawal looks like. We go to the bank, we ask for $800 or whatever, you go to the ATM and you pull out money. So that's you actually taking money from your balance. So if you had $1,000 in that account and you take out 500, well, you have 500 left, right? So that's essentially how I look at wash loans. The other type of loan, when people are starting to, talk about arbitrage and leveraging and borrowing from themselves, you'll hear them called alternative loans. Some call them different name, but usually you'll hear them say alternative loans, meaning that you're going to charge yourself a certain amount of interest so that you can get a loan out on yourself, but you're not actually using your money that's in the cash value account. Let me show you. So let's say that this is a cash value account, okay? And let's say that each block equals $10,000. So let's see, I got 10, 20, 40, 60, 80, 100. So $100,000 in your cash value account. Now, let's say that each year your cash value account grows by 2 blocks each year. So 1, 2, and then another year, 3, 4. So that's 2 years. So now I have 10, 20, 30, 40, $140,000 in my cash value account. Now, let's say that I wanted to put a down payment on a home, a rental house. And I say, man, I found a really great rental property. I want to put $60,000 down. I have $100,000 in my checking account over here, but I also have $140,000 in my cash value account over here. So if you think about it, if I had all access to what's in my cash value account plus my checking account, that's $240,000. So when you look at the total of what you have as far as liquidity, $240,000, you have some options, right? Now, usually what we do, or what we were conditioned to do, is to actually spend our money. So a lot of people go into their checking account, and let's say that the down payment for the rental property is $60,000, and they will take the $60,000 out, depleting their account down to $40,000. Now, we know that a checking account doesn't necessarily grow money, right? You're not going to get some super insane high rate of, return with that. But in a cash value account, you definitely are growing money, because remember I said you're growing money index, meaning you're only going to get the gains of the market, none of the loss. And in that situation where you're getting none of the loss, all you're doing is gaining. Even in the bad years, you might just maintain what you have. So let's say, again, like I said, you need $60,000 for the down payment of this home. And instead of, reducing your liquidity in your checking account, you come over here and you say, okay, I could do a wash loan. So as I said, wash loans kind of resemble a withdrawal, and I can take 20, 40, 60 out. And what would that leave us? That would leave us 80,000. You're like, whoa, yeah, that's what money's for, Kristen. It's there to spend. But I caution you on that. And actually, I'm going to challenge you. Money is definitely there to spend. But I always say, grow money first and then spend it. So if we're thinking about different concepts such as arbitrage, what we can do is this. I'm going to put this back. My account still has 140,000. That's my cash value account. And I need 60,000, but I have a question for you. Is 140,000 growing at 8% going to give me more return? Or $80,000 at 8%, is that going to grow me more? No, we know the answer is if you have $140,000 growing at 8% versus $80,000 growing at 8%, you're definitely going to make way more money, right, on the 140,000 versus the 80. So if you were to take this out, you have $80,000 growing at 8% versus leaving it in here and 140,000 growing at 8%. Now I already hear you. You're saying, but Kristen, this still doesn't make any sense. If I leave the money in there, how am I going to get $60,000 for my down payment? Let me show you. Now we've already determined what wash loans are, like withdrawals are like taking it out. But what if you said, hey, listen, life insurance company, I have $140,000 in here. I love that it's growing at 8%. I really don't want to mess with this. Is there a way I can just kind of use this as collateral and, take a loan out? I'll charge myself some interest. That way I can leave this in here growing at 8%. The company says, sure, that's what we do. That's why you're over here. And so let's say we have off to the side our loan of $60,000. Need 2 more blocks. And you're saying, but Kristen, wait a minute, where'd this come from? We have our $140,000 here, we got a $60,000 loan here. Well, this is, like I said, off to the side and not really affecting the $140,000 growing at 8%. So the insurance company knows it's there, and they know if you were to pass away before you even get to pay this off, or even if you didn't even want to pay this off, they'll just take it out of here along with the life insurance that you have covering this cash value account, okay? So let's say that this $60,000 loan is, like I said, you're growing at a rate of 5%, because remember, you're charging yourself 5%. So every 2 years, I'm going to add a block here for that 5% charge against yourself. Because, of course, if you're charging yourself interest and you don't pay this off, this is going to continue to grow, right? But think about it here. Over here, I'm growing at 8%. So at a rate of 8%, I'm actually making more interest over here by leaving this $140,000 here than the actual interest I'm paying over here off to the side with this loan that I use this as collateral to get. But question, if I'm growing 8% on $140,000 and I never touched it, I left it in here knowing I'm going to make way more money getting 8% off of $140,000 versus 8% off of $80,000. And then I have this loan that I'm charging myself, okay, the insurance company knows it's there, at 5%. Isn't my 5% that I'm charging myself less than the 8% that I'm gaining over here? Yes, you're correct. That's called arbitrage. Because if I'm making more, right, I leave the money in there, I'm making more over here than what I'm charging myself over here, well, then this is going to grow a lot faster. This is my positive cash flow pile versus my negative cash flow pile, which is a loan. So the years go by and my loan, of course, grows because I'm charging myself interest and I'm not even paying attention to this loan. I'm not paying it off. I'm not even paying the interest on this loan. I'm just letting it grow. But over here, man, now because I left this cash value account alone, man, it is really starting to pile up because I know I'm making a ton of money off my interest rate on my cash value, and the interest rate that I'm earning in my cash value is way higher than the interest rate that I'm actually charging myself on this loan. So years and years go by and you continue to gain interest in your cash value account. Also, you continue to gain interest on your loan. So at a slower pace than what your cash value is building at, but it's still accruing. Now, another reminder, remember, like I said, this is growing at 8%, which is a positive 8%. This is charging yourself a negative 5%. So the difference between the two is a positive 3%. And if this were to grow at 10% and this is charging you at 5%, then you're positive on that money that you left here instead of taking it out is now a positive 5%, meaning you are making money off loaning money to yourself by leaving it here. Now, people will say, Kristen, but you never paid your loan. What happens to that money? Who has to pay? Because eventually someone has to pay this loan. Well, you're correct. Now, let's just say it's my time to go, right? And hopefully that's like 97. Who knows though? But it's my time to go. And I have this outstanding loan that I never paid and it was growing at 5%. But then I have my cash value that I've been letting grow as well. And so let's add this up. Before the insurance company sends your beneficiaries the check, they're going to say, okay, hold on. Before we pay you out, she had some cash value, right? She still had the life insurance that was being paid for. So whether you're paying for the original amount of life insurance that you started out with, or if you decrease that amount of life insurance that you're paying to free up or add more or grow more cash value, right? But whatever amount of life insurance you were still paying for, your family will get that life insurance as well as the cash value that you never used. But also don't forget, like I said, the life insurance company said, hey, hold up a sec. She had a loan. So before we pay you out, we got to pay this loan off first. Okay. So let's count these loan blocks out. Remember, we were charging ourselves 5% on that $60,000 loan. We never touched the interest. So this basic loan at 5% continued to grow. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So we still owe the insurance company 11 blocks. And you're probably thinking, well, dang, Kristen, we started out with 60,000. This is 11. This is 110,000. And you are correct. But think about it. We left the money to grow, and the money grew at a way higher rate or faster rate than 5%. So let's count this out and pay our debt to see what we have left. So they're going to pay that loan off with the cash value first. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So we took our 11 blocks out of our cash value. We paid our loan off. So I'm going to set that off to the side over here. And now our loan is settled. But how much do we have here now? 2, 4, 6, 8, 10, 12, 13, 16, 18, 20, 22, 24. So because we left the money in the cash value account to grow faster than what we were charging ourselves, we have 24 blocks still left after we paid our debt. Originally, had we taken the $60,000 out of the cash value, then we would not end up with 24 blocks because we would have had less money growing at 8%. So when you hear people say work smarter, not harder, this is exactly what they're talking about. And also when you hear people say play chess, not checkers, that's what they're talking about too. So if you're on the right side of interest, meaning you're actually earning interest, and the interest that you're earning is more than the interest that you're paying, you're in a positive or net positive interest situation. And if you're always in a situation where you're gaining more interest than what you're paying, well, that's the right situation to be in. And this is why all these crazy people are getting Index Universal Life, putting money into their cash value, maxing it out so that they have access to more way earlier in the policy and upfront. This is why they're doing this. so that they can leverage themselves, that they can make more interest than what they're actually charging themselves. And when they finally do pay the interest back, whether it be at the time of their death or if they pay the interest while they're alive, at least they're paying it to themselves and not the bank at a higher rate. So don't forget my number one rule. Always make money on the money that you plan to spend before you actually spend it.